Candidates, welcome to the lesson. Today we are going to answer the last question from the April 2024 sitting. Question 5A reads, discuss 5 reasons why companies do not distribute all their profits to shareholders. Reasons why companies do not distribute all profits to shareholders. Candidates, we know that shareholders invest in companies so that they can earn dividends. There are times when the company may decide not to distribute the profits to the shareholders in form of dividends. The question is, discuss 5 reasons why companies do not distribute all their profits to shareholders. One of the primary reasons companies retain earnings is to reinvest in the business, because that can fund company projects, that can fund opportunities, as he says, okay, and then expand into new markets. The retained earnings can be used to upgrade facilities. They can be used to acquire other companies, and such investments are aimed at increasing the company's future profitability and ultimately shareholder value. Though shareholders may not receive dividends now, this money is reinvested, then the investments will earn more money, or will increase the shareholder value in future. The shareholders forego their dividends now, but in future they will enjoy ultimately, okay, these are future profitability. That is true. Can I have another point? That's a good point. Reinvestment opportunities. Reinvestment opportunities. Because candidates, retained earnings is a source of capital. So instead of a company, for example, borrowing money from banks, the company can use its own profits as a source of capital. Yes. Give me another point, please. Building financial cushion is another reason. Building financial cushion. When a company retains profit, when a company decides not to distribute all profits, the profits that are retained can be used as a financial cushion. Retained earnings can, in other words, allows companies to build what we call cash reserve, and this cushion can be essential during economic downturns, during unforeseen challenges, or even during unexpected opportunities. So it provides, this retained earnings provides financial stability and flexibility, reducing the need for emergency borrowings. You understand? Businesses may be faced with unforeseen challenges, like economic downturns. When the economy slumps, you may find that the company may not make business. You recall, some of you are around during the COVID crisis. Companies that had cash reserves were able to maintain their employees, were able to pay their fixed costs through the crisis. So that is one reason why businesses do not pay all profits to shareholders. You understand? Yes. Another reason is debt reduction. Debt reduction. What do I mean by debt reduction? Now, many companies may have what we call outstanding debts, and using profits to pay down debts Using retained profits to pay down the debts can be a sound financial strategy, because reducing debt obligations allows or lowers interest expenses. It also improves credit ratings, and frees up cash flow for future investments or distributions. Do you understand? So retained earnings can be used to reduce debt obligations. Debt obligations. The fourth reason is what we call share repurchase. Share repurchase. Share repurchase means buying back the shares. So instead of distributing all profits as dividends, some companies engage in what we call share buybacks. Share buybacks. And that reduces the number of outstanding shares, which can increase the earnings per share and potentially boost the stock price, which then benefits the same shareholders. Do you understand? Share repurchase. Number 5 is related to regulations, regulatory and tax considerations. Companies may not distribute all profits because of regulatory and tax considerations. In some countries or jurisdictions, there might be legal restrictions on the amount of profits a company can distribute. Additionally, tax laws can incentivize. They can what we call incentivize. Tax laws can incentivize companies to retain earnings because dividends are often taxed at a higher rate than capital gains, which shareholders realize when the stock price increases. Do you understand? Capital gain happens when the value of share, the market price of share goes up. You understand? You understand, candidates? Tax laws can give an incentive to companies to retain earnings, because when dividends are paid, there is a tax on that payment of dividends. There may be a higher rate that is applied on the dividends that are paid. So instead of paying, the money can be retained so that the shareholders gain through stock price increases. So that is another reason. There are many reasons, candidates, and we can go on and even cite the company's financial health is another reason. The company's financial health. What do I mean by the company's financial health? Now, a company struggling financially might need to retain earnings so that it can shore up its balance sheet. You understand? Because when retained earnings, candidates, the retained earnings forms part of equity. So that shores up the balance sheet. You understand? So the equity of the company is kind of increased. There's also the aspect of the cash. Instead of paying cash, the cash is retained. So one reason is for the sake of the financial health of a company. Another obvious reason, candidates, is the dividend policy of the company. The company's dividend policy can be a reason for companies not to distribute profits. The company's dividend policy. Policy here means guideline. Companies may have their own guidelines on payment of dividends. So some companies have a long-standing history of paying consistent dividends, while others prioritize growth and might distribute less profit so that the company has retained earnings for reinvestment. So the company's dividend policy determines if companies will distribute all profits to shareholders or not. Is that clear? So these are how many reasons? Reinvestment opportunities, number one. Building financial cushion, debt reduction, share repurchase, regulatory and tax considerations, the company's financial health, and company's dividend policy.